A year from now, your bank app still shows the same number. Your savings didn't vanish. Your salary still arrives. The markets are still open. The news anchors still smile. And yet, quietly, something has changed. The rules feel different. Access feels tighter. Prices move strangely. Governments talk about stability, but the word feels heavier than it used to. Now, imagine waking up and realizing that what you thought was safety was just familiarity. Cash, gold, silver. Three forms of protection, three very different promises. And the uncomfortable truth is this. Only one of them protects you depending on what actually comes next. So here's the real question. If the next phase of this cycle is not a single crisis, but a blend of monetary stress, geopolitical fragmentation, and slow financial repression, which one survives? And more importantly, which one survives for you? Most people approach this debate emotionally. They don't admit it, but they do. They choose based on stories they've absorbed. Cash feels practical. Gold feels timeless. Silver feels explosive. But survival isn't about stories. It's about structure. Let's start with cash. Cash feels safe because it feels stable. It's familiar. It pays your bills. It sits quietly. It doesn't swing 5% in a day. In uncertain times, the instinct is to move toward what feels liquid and controllable. And in the early phase of stress, cash often wins. When markets fall, when assets crash, when panic hits, cash becomes king. Prices drop. Bargains appear. Those with liquidity can move. They can buy discounted assets. They can survive layoffs. They can wait. That's the first illusion of safety, and it's not entirely wrong. In deflationary shocks, cash protects purchasing power. When demand collapses, prices follow. In those moments, holding currency is not cowardice. It's strategic patience. But here's the part most people forget. Cash is a liability issued by someone else. Its value depends on trust in a system that is increasingly under strain. Governments carrying record debt loads. Central banks balancing inflation fears with recession fears. Political systems polarized and reactive. If the next phase isn't pure deflation, but rather slow erosion, negative real interest rates, capital controls, subtle restrictions, targeted liquidity, cash doesn't collapse overnight. It bleeds. You don't wake up bankrupt. You wake up poorer. The number stays the same. The purchasing power shifts, and that shift is silent. Financial repression rarely announces itself. It appears as policy adjustments, temporary measures, protective regulations. It often arrives wrapped in the language of stability. If interest rates stay below inflation long enough, cash becomes an anchor dragging you backward. You feel safe while losing ground. Now let's move to gold. Gold does not produce income. It does not innovate. It does not expand. It simply sits there. And that simplicity is its strength. Gold is not someone else's liability. It does not depend on quarterly earnings or political promises. It does not need confidence in a banking system to exist. Throughout history, when trust fractures, gold absorbs fear. But here's the nuance. Gold does not always move when you expect it to. In sharp liquidity crises, gold can fall. When investors scramble for dollars, they sell what they can. Even gold. We saw this in 2008. We saw it briefly in 2020. Gold dipped before it surged. Why? Because in the very first wave of panic, cash demand spikes. Gold is not immediate survival. It is medium-term trust insurance. If what's coming is inflationary policy layered on top of geopolitical stress, sanctions, reserve diversification, fragmented trade blocks, gold becomes attractive, not because it generates wealth, but because it preserves optionality outside the system. Central banks understand this. That's why many have been accumulating gold quietly over the last decade. When governments themselves diversify into a metal that yields nothing, it tells you something about their expectations. Gold survives when currencies compete and trust erodes. But gold is not agile. It protects wealth across cycles. It does not help you pay next month's rent. And then there's silver. Silver is different. Silver is different two worlds. Half monetary narrative, half industrial reality. It is used in electronics, solar panels, medical equipment. It moves with economic activity. But it also carries the historical shadow of money. This dual identity makes silver volatile. When economies expand and industrial demand rises, silver can surge. When investors seek monetary hedges, silver can surge. But when liquidity dries up or industrial production slows, silver can collapse faster than gold. Silver amplifies the cycle. It offers torque, not stability. That torque can be intoxicating. When silver runs, it runs hard. But survival strategy is not about adrenaline, it's about resilience. So now we step back. If what's coming is not a clean recession or a clean inflationary spiral, but a blended environment, slow growth, periodic liquidity squeezes, geopolitical tension, subtle capital management, none of these assets exist in isolation. The real variable isn't price movement, it's access. In fragmented systems, access becomes more important than valuation. Cash is accessible until it's restricted. Gold is accessible if you hold it directly. Silver is accessible but subject to market swings and liquidity gaps. The real survival question becomes, what gives you optionality under multiple outcomes? Let's imagine three paths unfolding simultaneously. A recession hits. Markets fall sharply. Asset prices decline. Those holding only gold watch equities crash while gold hesitates. Those holding cash can deploy capital at lower prices, but then policy responds aggressively. Rates fall, liquidity expands, currency weakens, inflation expectations rise, gold moves, silver moves even more. Cash holders feel trapped. Then, geopolitical tension escalates, trade fractures, sanctions expand, reserve assets shift. In this world, gold's neutrality becomes powerful. Silver follows with volatility. Cash becomes jurisdiction dependent. Notice something? No single asset wins every phase. The first surprise is that survival is not about choosing one champion. It's about understanding sequence. Sequence determines advantage. If the next 12 months begin with contraction and transition into currency stress, cash leads first. Gold leads later. Silver amplifies both up and down. If instead inflation reaccelerates immediately, cash loses quietly from day one. Gold stabilizes. Silver surges but swings violently. And if fragmentation intensifies, capital controls, digital monitoring, tighter banking rules, physical possession matters more than digital balances. Now let's talk about psychology. When uncertainty rises, people overcommit to certainty. They want one answer, one safe harbor, but markets punish rigidity. Survival strategy is not about conviction, it is about flexibility. Cash provides liquidity, gold provides insurance, silver provides leverage. Liquidity allows you to respond. Insurance allows you to endure. Leverage allows you to grow or shrink rapidly. The mistake is assuming survival equals maximum return. Sometimes survival equals minimizing irreversible damage. If financial repression deepens through prolonged negative real rates, cash slowly deteriorates. Gold becomes ballast. Silver oscillates. If banking stress intensifies through localized failures or restrictions, direct ownership of tangible assets gains value. If deflation dominates unexpectedly, cash regains dominance. Precious metals stagnate temporarily. This is why sequence awareness matters more than ideology. Ask yourself, are you preparing for a headline or for a pattern? Headlines are loud, patterns are quiet. The quiet pattern right now suggests mounting debt burdens, aging demographics, energy transition costs, geopolitical realignment, and political incentives to avoid overt collapse at all costs. Avoiding overt collapse often means slow pressure. Slow pressure erodes purchasing power. It does not shock it. In slow pressure environments, gold quietly outperforms cash. Silver oscillates violently around that trend. But in fast panic environments, cash dominates first. So what survives what's coming now? The uncomfortable answer is this. What survives is not an asset. It's positioning. Positioning that acknowledges uncertainty instead of denying it. If you hold only cash, you are betting on deflation or short-term panic. If you hold only gold, you are betting on long-term currency erosion. If you hold only silver, you are betting on volatility resolving upward. Survival is rarely about all-in bets. It is about constructing resilience across plausible paths. Liquidity cushion in cash, core insurance in gold, tactical exposure in silver. Not because diversification is trendy, but because the future is layered. And here's the final layer most ignore. Jurisdiction. Where your cash sits matters. Where your gold sits matters. Where your silver sits matters. In fragmented geopolitical systems, location becomes leverage. The lesson isn't that one metal or one currency wins, it's that adaptability wins. When oil hit zero, people thought the world was ending. It wasn't ending. It was repricing risk. When currencies weaken, when governments adjust rules, when markets swing violently, they are not ending either. They are redistributing advantage. The ones who survive are not those who predict perfectly. They are those who remain liquid enough to move, insured enough to endure, and disciplined enough not to chase every spike. Cash survives the first wave. Gold survives the slow erosion. Silver survives the momentum bursts. The question isn't which one survives absolutely. The question is whether your structure survives the sequence. And if you can answer that honestly, without emotion, without attachment, you're already ahead of most people watching the same headlines, still searching for a single, simple answer.